This podcast is brought to you in association with BSE and its investor awareness initiatives. Passive investing has been gaining popularity among investors in recent years. Keeping in mind the growing interest, mutual funds have launched several index funds and exchange-traded funds that mimic the performances of various indices. These products are liked by investors who are cost-conscious and by those who believe that equity mutual funds, which are actively handled by fund managers, will find it difficult to beat the index returns. Is the growth in passive funds here to stay? Will investors miss out on a chance to make returns over and above the indices if they stick only to passive funds? We are about to discuss this and much more in today's episode, which is part of the BSE Investor Week special podcast. I am Nishant Vasudevan, the markets editor of the Economic Times and your host for this episode. Joining me today are two experts who have their fingers on the pulse of what's happening in the world of passive and active investing. Let me welcome Prateek Oswal, who heads Motilal Oswal Mutual Fund's passive funds business, and Feroze Aziz, Deputy CEO of Anand Rathi Wealth. First up, Prateek. Hey Prateek, thank you for joining in.
Hi Nishant, thanks for having me. Look forward to our conversation today.
Absolutely. So the first question has to be, in 2024, we've actually seen so many passive mutual fund scheme launches. I mean, something like we've never seen before. Now, what explains this rush of passive product launches?
Yeah, so honestly, we believe that the definition of passive has broadened in the last 5 years. So what has happened is passive used to be Nifty and Sensex. But what has happened the last 5 years is now passive has become equivalent to almost like a quant strategy, where the rules are completely transparent. That's what I believe the current definition of passive is. We used to have Nifty Sensex. Today we have passive across sectors, themes. You have passive across commodities, factor funds, international funds. So what has happened is now a lot of asset managers, including us, are now looking at passives from a perspective of having a fund in each category. And I think historically there has been not that much traction, but this year there's been a lot of traction on non-traditional indexes. In fact, what's really interesting, Nishant, is that we did an investor survey. One of the most interesting insight from that survey is the fact that most of the investors today, 61% of the investors, for them the most popular category is actually thematic and sector funds, which is very interesting. And second most popular category is your traditional Nifty 50 Sensex. So that is what has happened. And I think the broadening of definition of passive, the fact that, asset managers seeing there's so many flows coming in passive funds, I think combination of that has led to a lot of AMCs getting into the space in a very big way. And that's why you're seeing so many NFOs.
Right. And people say this could just be a tip of the iceberg because, I mean, if you have these big passive players like BlackRock coming into India, I mean, the market will be flooded with a lot more. What are your thoughts on that?
So I think what we believe is that yes, there's going to be a lot more funds coming in. You can think of an idea and there can be a passive fund, and I do believe that simplicity may have been lost in the last 4 to 5 years time. And today you're looking at the passive fund industry, which is a lot more complex. There's a lot more funds. We ourselves have about 40 mutual funds in the passive fund space. ETFs, index funds, probably the highest. And but we also believe that we have lots of type of customers. We believe that there are different types of customers. We have institutional, retail, and we have to be able to cater to all of them and their needs. And that's why we believe there's going to be a lot of funds coming in. If you look at the US AMCs, if you look at Vanguard, BlackRock, as you said, they don't have 40, 50. They have hundreds of passive funds. There are more ETFs in the US than stocks. So you can imagine the sort of impact that an ETF or an index fund is going to happen over the next decade, because what we believe is that the India normally follows the US by about maybe 10 years. So you can expect a lot of launches, probably multi-folds of what we've seen so far in the next 5 to 10 years time.
Yeah. I mean, one very interesting point that you raised now is about product innovation. But is it true that there is more scope for product innovation in ETFs and index funds rather than actively managed schemes?
No, I don't think so. I think product innovation is something which is happened in a very big way in the last 5 years. I think the difference between invention and innovation is customer adoption. But unfortunately, there's the very small amount of innovation. I think the innovation has happened in fixed income with target maturity funds. The innovation has happened in international funds. The innovation has happened in factor funds. Maybe certain thematic funds it's happened, but overall, I would say 1 out of 10 ideas work. So I think invention and innovation. I would say that the today's asset management industry requires more invention or innovation in the distribution side. Mutual fund companies today are dependent on a lot of partners. So they themselves don't do a lot of marketing themselves. So the idea is, how do we, mutual fund companies today, help investors decide which product to buy, which product to sell. I think that is something which will really lead towards mass adoption of, mutual funds in a very big way. So I think any innovation on distribution side will be a lot more beneficial for this industry apart from the product side.
Right. Pratik, but what do all these things, what do they mean for investors? Because they'll be swamped with so many products. I mean, if you look at the current category of schemes, that they themselves are confused. So, I mean, if you add many more products, what will that mean for investors? Isn't that more confusing for them? Which one to choose, which one to kind of stay away from, etc.
Honestly, people were very confused even 5 years back. You know, so I think there's always been confusion. There's this a Nobel Prize laureate called Harry Markowitz. So what he says was that if you look at diversification, diversification is very important for mutual fund investors, and that's why you invest in mutual funds, because you have a diversified portfolio. What he said is that the value of diversification falls beyond 35 stocks. So if you have more than 35 of stocks in your portfolio or in your mutual fund, anything more than that is not going to add much value. But what he also says is that it's always not bad to have them, in your portfolio. It's not going to act in a very negative way. So I think, there's always been confusion in the industry, even 5 years back, where there were hundreds of mutual funds. Today there are thousands of mutual funds. Tomorrow there'll be 10,000s of mutual funds. So we believe that it is going to stay the same, because there are just so many mutual funds, and unfortunately, every investor is different. And what is really interesting is that, when you go on the ground and you talk to these people, not one of them has a similar perspective on equity investing. Not one of them has the similarities. So like, if you have 10,000 clients and not one of the clients have the same portfolios, and not one partner or distributor has the same list of mutual funds that they promote. So everyone is so different, and that is the beauty of equities. Even a bad quality stock will have lots of trading. In fact, the bad stocks have more trading volume than the good stocks. So I think
That's
we are in a very dynamic market where, there's a demand and supply, and there is demand and supply for all sorts of things in this market, and everyone's very different.
right. Pratik, the reality today is that many fund managers who actively manage funds, they are struggling to beat the benchmarks. So, keeping that in mind, the current debate about passive versus active, I mean, isn't that kind of, a counterintuitive kind of a point, that longer term passive funds are going to obviously do better than actively managed funds? At the same time, the industry continues to push actively managed funds.
So what has happened is that in the investment management industry, you have alternatives, you have the whole sort of, solutions. So what has happened in the last 15 years is that the mutual fund industry has actually become quite passive. In fact, the active flows have become negative. So there's a shift between active going to passive. Today, I think 55 to 60% of the mutual fund industry is passive. But what has happened in the last 15 years is that the active money has gone outside the industry. So the problem is not active, passive, mutual funds. The problem is the behavior, and I believe that if you're making the same returns as an index fund, you are doing better than 70 to 80% of the investors today. So that's the reality, and unfortunately, people are not able to, grasp it. So I think the behavioral issues are the most important. I think more about active, passive. I think active will do extremely well. In fact, despite of the index beating active funds and mutual funds in the US and hedge funds in the US in the last 10 years time, active funds are bigger than passive funds. So I think India also, active funds will do fine. If you look at India, this is a very interesting statistic. If you look at every single active manager in India in the last 20 years, not one of them has done badly. Investors have done badly, but if you look at track records of fund managers, yes, they may not have beaten the index, fine, cool, okay, but not one of them has done badly. So, I think people are doing the right thing. The behavior seems to be the most problem, and I think the moment investors started focusing on behavior, on how do I make sure that I don't mess up on the behavior front, that's when you'll see wealth creation happening.
That's a sound piece of advice. But before we wind up this conversation, if there was one fund, one passive or active fund from your fund house, Motilal Oswal, and one outside your fund house, if you were to have pick up these the favorite funds, which one would that be? One inside, one within your fund house, and one outside.
So I can't only comment on anyone outside, but within the fund house, I think the one strategy that we are very, very on the passive side is the Nifty 500 index fund. That is something which we believe is a product which is all weather. It captures 90% of India's stock market. It's the true benchmark in India, and that is one fund that excites me the most. It's also the simplest fund we have. It's the most boring fund we have, but it is one fund which I know in the next 50 years will be able to do extremely well. So I think that's one fund which I'm very excited, and something, honestly, my entire AMC tends to sell this single fund. The rest are just for, demand and supply. But the funds that we are excited about is this particular fund.
Great, great. It was great having you on the show, Prateek. Thanks a lot. Thanks for your insights.
Thanks for this, and I look forward to having the next one with you.
Now on to Feroz. Hi, Feroz. Thank you for being a part of the show.
It's my pleasure, Nishant, to be with you on your podcast.
Great, great. So, to start the discussion, see, we are seeing many investors increasingly preferring index funds and ETFs over actively managed products. Now, are they jumping ship a little too early, or is that the way to go ahead?
So, Nishant, I think some people are shifting a ship. Now, like you rightly said, if I put some data to it, 17% of the total AUM 5 years back was in index funds. Now, 21% of the total AUM is in index funds. It's gone up 3.7 times. It was some 1.5 lakh crore. Now it's close to about 5.5, 6 lakh crores. So you're absolutely right. You've got the trend bang on. People are moving ship. Have they done it sooner? I personally think that the answer to this question, whether I should move to passive or not, lies in the detail, right? So some people, it might be better to be inactive because they have the knack of picking the right active fund. Are all actives good? The answer is no. Out of the 632 funds, it depends on your skill of picking them up.
Right. No, that is a very valid point that you raised on whether all active funds are good or not. But whenever you talk to a lot of your client base is predominantly HNIs and ultra HNIs, when you talk to them about an active versus a passive strategy, what is the sense that you get from them?
See, we are in the business of mathematics. Agar main interior designer hota, if I was an interior designer, people can agree to disagree. But if it is a business of mathematics, most sane people will come on the same page. Now, what am I trying to get to is that when you speak to a client, the client says, I love passive. I said, great, no problem. I met one guy. Okay, he says, he in fact went to the extent of saying, this gentleman, very rich guy, almost 1,000 crore plus. The guy said, all 152 fund managers are idiots of the nth order. Okay, I was shaken up. मैंने कहा, ये क्या कह रहे हो sir? 152 लोग, 152 people, paint under the same brush. Somebody is from IIT, somebody is from Cambridge, somebody is from IIM. All of them are idiots. He said, yes. I said, why, sir? He said, none of them beat Nifty, yaar. I beat Nifty so well. Then I said, sir, did you check your 800 crore direct equity portfolio? Transaction by transaction. If you bought and sold Nifty, you have done 13,000 transactions over the last 8 years. He has done 13,000 buying and selling stocks. When I actually calculate, put this 13,000 on an Excel sheet, put the date of transaction, put the Nifty on that date, and then hypothetically, if this gentleman who called everybody an idiot would have bought and sold Nifty, who would have been richer by 121 crores. So I said, sir, they are idiots, but they are lesser idiots than you. Data says so. I Firoz नहीं कह रहा है, डेटा कह रहा है. तो ईगो मत लाइए, क्योंकि मैं नहीं कह रहा हूं, ये एक्सेल शीट कह रही है. So that person, for that person, he should not be in direct equity. He should surely not be in mutual fund also. He should go to an index fund like Nifty. Whatever they say initially might be dramatically different than what math is screaming at them, is the point I was trying to get to, Nishant.
Correct. It's a pertinent point, but it is also the fact that increasingly several mutual fund managers are struggling to beat the benchmark indices on a consistent basis. So doesn't that strengthen the case for passive investing strategies in investment portfolios?
It certainly does, Nishant. If you look at benchmarking and people beating the benchmarks is become a lot more difficult than it was about 10 years back. But there are two things. It is not the same people beating the benchmark every year. See, this is where the trick of the trade lies. Now, if there are 43% of the people who have beaten their respective benchmark last year, and this year so far, if there are 41% of them, it's not the same 43%. So what can one derive? If you are going to go into active funds, you will have to be far more agile, is what statistics tells you. In an index fund, you can put it and forget it for 15 years. You can be married to equity for 20 years, but don't be married to a fund manager for more than 2-3 years.
Fantastic. That is another, crucial point that you've raised, which takes me to this question. So, which are the areas where passively managed strategies work better than actively managed ones?
So, let me give you away some of my secrets which can be useful to your audience. One is passive indices. Large portion of the money is in Nifty and Sensex. Okay, if there is 7,98,000 crores between ETFs and index funds, 6 lakh crores in ETFs. 84% of this money is between these two indices, Sensex and Nifty. But there is a new trend which is emerging, which is called smart beta, where a formula is changing the index. Again, a very nuanced point. All the other conventional indices are growth driven. They are growth biased. What do I mean by that is, Nifty, if the stock does well, it gets more weightage. If it gets more weightage, there is more money coming into it, and it does even better, and then there's more money. It's a chicken and egg story. So one point which I'm trying to highlight to the listeners is, if you are in a value phase where the market is respecting value and you are an index fund investor, you are going to be in trouble. But if you are a index fund investor and growth चल रहा है, तो आपका पोर्टफोलियो बहुत अच्छा करेगा, क्योंकि indices growth के आधार पे बनी हुई हैं. In a passive fund, let's assume all the money, 41 lakh crores of equity mutual funds, hypothetically was passive and was supposed to move to NSE 500. There are 4 such companies where there is no free float. Even if everybody surrendered their shares, NSE 500 can't be created, because the kind of money which needs to flow into those 4 stocks, for example, I'm giving you the amplified example. Even if the promoter sells all his equity, you will still not be able to fill its weightage in NSE 500. So NSE 500 is a hypothetical index which you can compare yourself to. That's why you see in the US, some of these top businesses are quoting at such stupid valuations that the analysts are looking for stories to justify a valuation for a technology business which is not making sense. Businesses have been in loss for 25 years and still quote a valuation. And today the institutional research is justifying that valuation. It's not happening because of the business. It's happening because of the index fund investing, which Warren Buffett Saab has promoted in the US.
Right. Let's hope we don't reach such a situation at, probably, I don't know, any point, but Before we wind up this discussion for the benefit of our listeners, could you suggest some of your best rated passive products, the ones that you think are must haves in portfolios?
Must haves in portfolios, I would say definitely you can look at a Nifty 50 index. Okay. Of course, however conventional it may sound, but my desire is for the mutual fund industry to capitalize on the stock borrowing and lending mechanism to give me an extra return more than Nifty, which is what I think US is doing very, very well. Because a Reliance stock can be lent and you get a fee for it. So most of the index funds are running a negative alpha. They can come into the positive alpha like Vanguard does. So having given that caveat, I think someday in the industry we will get there. But index funds on Nifty and some smart beta strategies which are theme based, I would say Nifty Capital Market Index, which has 15 businesses of capital market related businesses, wealth management, asset management companies, depositories, brokers, all put together. There's an index which was formed about 2 months back. And I have to give you my disclaimer that Anand Rathi Wealth Limited is also part of that index. Seems to me like a good passive fund which can outperform NSE 500 over the next 4-5 years.
Absolutely. Wonderful. Feroze, that was great having you on the show. Thank you for sharing your views with our listeners.
It's my pleasure, Nishant sir.
That wraps up our episode. From this discussion, it's quite clear that the growth in passive funds is here to stay. But investors would do better by having a mix of both passive and active products in their portfolios to maximize returns. I hope our listeners have gained a lot of insight from our guests. Thank you once again, Feroze and Prateek, for joining us for this conversation, and a big thanks to our listeners for tuning in. This episode was produced by Sirohini Jain and Vinay Joshi, sound designed by Rajas Nayak and Amrit Reggie, executive producers Anirban Chaudhary and Arijit Burman. This is your host Nishant Vasudevan signing off. Have a great weekend.